In the early 80s, when Fed Chairman Volcker was trying to strangle inflation out of the system with double-digit interest rates, inflation was also at double digits. So if he was going to make a mistake, that was a big buffer to make a mistake. Our inflation rates today are much lower. And so the Fed actually has less room for error. And I do believe that higher for longer and thinking that inflation was the big risk out there has put us somewhat in harm's way.
When the U.S. Federal Reserve started hiking rates at the fastest pace in history in 2022, many financial experts, prominent hedge fund managers, and legendary investors warned that the central bank was going to make a mess of things and send the global economy tailspinning into complete and utter chaos. Not only did the central bank insist on hiking rates so aggressively to bring down inflation, but it also insisted on leaving them high for longer and sending only aggressively hawkish signals to the markets to keep things under control. Now, just like Fed Chair Jerome Powell warned during his 2022 Jackson Hole speech, during which he repeatedly invoked former Fed Chair Paul Volcker's name, Americans are feeling every bit of pain from the Fed's policies, and the pain is swiftly spreading to other major economies. For example, last month, the Japanese yen fell to a record 38-year low against the dollar. Higher interest rates in the US incentivize investors to sell the yen to buy US treasuries, which have higher returns than Japanese government bonds, given the country's record low interest rates. This results in a self-perpetuating cycle, encouraging investors to keep selling as the yen falls further. Despite the latest rounds of invention from the Bank of Japan, the Japanese stock market is still on a roller coaster ride, dropping to record lows today and recording substantial daily gains the very next day. American consumers are also having a hard time, especially as prices have remained high despite reports of inflation slowing and wages increasing. In the latest episode of her monthly In the Know broadcast, ARK Invest founder, CEO, and CIO Cathie Wood explains that these are all signs that greater challenges lie ahead for the US and global economy. Cathie believes the US economy, and by extension, the global economy is approaching a deflationary decade that will be marked by lower prices and slower economic growth. As we bring you clips from the video, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thank you, and enjoy the video.
And one of the things you'll hear about increasingly in the news, I think, is the idea that the carry trade, which involves, believe it or not, the yen, is unwinding. So if you look at the carry, what people mean by the carry trade, it means that many investors and speculators borrowed yen. So they were effectively short yen. They borrowed yen because the interest rates in Japan were so low relative to the rest of the world. So they borrowed there and then redeployed those assets, put them into dollar-based assets or other currencies, but primarily dollar, often into our treasury bonds, which were yielding more. Now, since 2011, the yen has either been depreciating or stable. And so it was kind of safe if you were making the bet to short the yen or borrow the yen, you weren't taking that much risk. And in fact, if the yen went down, you got the benefit of that, plus you were earning higher rates in the US. Some people think that part of the carry trade was by borrowing yen and then buying the Mag 6 or one of the broad-based benchmarks in the US, the S&P 500, the NASDAQ 100, both of which are very heavily populated and weighted with the Mag 6. So again, we don't know how much of this went on. There are some guesses. A Deutsche Bank study suggested it could be $20 trillion. Now, think about that. Our GDP is roughly $25 trillion. So can you imagine this carry trade, which was becoming a consensus trade, to the tune of $20 trillion? I don't know if that's true or not. The other way to put it in perspective is I believe the global equity markets today are priced at roughly $130 trillion. So $20 trillion in the context of $130 trillion is also a very large trade in the market. So we don't know the exact number. It does make sense watching how violently the yen is actually appreciating now that this carry trade is unwinding. So people who had bet on the yen continuing to depreciate are changing their spots. They're cutting their losses, or they're getting margin calls and are having to sell. They're forced sellers. Now, the other thing that could be going on, just trying to understand what else could be going wrong out there, we've tried to figure out, okay, where is the biggest leverage out there? And that carry trade certainly was leverage. So that's, yes, one source of leverage. Another is private equity. And this is where commercial real estate, and especially multifamily in the United States, could be instructive.
Cathie Wood is predicting a slowly and then all at once moment for the global economy in terms of the massive unwind needed to take out the huge amount of leverage in the system. Though she believes the unwinding will be more controlled than that of the great financial crisis, she predicts that it will be followed by a prolonged period of deflation, which will present a margin squeeze for consumer-oriented companies. According to the ARK Invest CEO, this is where innovation will come in, swiftly solving a lot of margin problems and enabling significant increases in productivity. She adds that though disruptive innovations like artificial intelligence and robotics will increase the unemployment rate in the midterm, their longer-term prospects will easily make up for the loss and help the global economy get back on track for more growth. Here are more clips from Cathie's video.
Monetary policy. The other thing that came out of the Bitcoin discussions we had in Nashville is, yes, Bitcoin could be a private money, taking us back to pre-Fed days, so pre-1913. Private money competing against, in today, public money, the dollar or other fiat currencies. And because of the rules-based monetary system that Bitcoin is, that could be very healthy competition. Basically, if investors don't like what the Fed is doing or the government is doing generally, they can increase their hedge in the form of a private money. Now, in terms of monetary policy today, what do we see? Well, we got the June update for M1. It's now up 1% on a year-over-year basis. So no longer declining. We went through almost 2 years, I think, of declining money on a year-over-year basis, certainly 1.5. So in the second quarter, let's just say money growth on a year-over-year basis was in the 0 to 1% range. GDP was close to, nominal GDP on a year-over-year basis, close to 6%. Velocity is therefore around 5 to 6%. The velocity of money is the rate at which it turns over. If we're right, and this cathartic moment, slowly and then all at once, causes consumers and businesses to hold off and say, okay, let me see what's going to happen here. Let me see if interest rates are going to fall. Or maybe the better way to say that, the probability that interest rates are going to fall has increased significantly here. And so if you know interest rates are going to fall, and now there's conjecture it could be 50 basis points in September, and then another 25 to 50 basis points in November or December, maybe both. If you're thinking that way and you're being educated by the media that that's possible, what are you going to do? You're going to wait for the lowest possible rate. Same thing with prices, and this is the deflation. This is where it gets a little concerning. If you believe prices are going to continue falling, you'll wait, and that lowers the velocity of money. So here we are. This is what really does cause a recession, when the velocity of money seizes up. Everybody says, wait, let me wait and see what's going to happen here. The history of falling rates is they are followed by a recession. The Fed is reacting. And very often, the NBER, the National Bureau of Economic Research, which a year or two later backdates a recession, that interest rate cut has usually taken place, when all is said and done, in the middle of a recession. So we could be a good way through it when the history books are written. At this point in time, be pretty much through it.
The U.S. Federal Reserve has been repeatedly criticized for using lagging indicators when devising monetary policies. While many ascribe the central bank's actions to incompetence, Real Vision founder and CEO Raoul says it's all planned. According to the renowned analyst and investor, central banks collectively agreed to keep debasing their respective fiat currencies in 2008 as part of the efforts to save the global economy from complete collapse during the Great Financial Crisis. Powell believes every step they've taken since then, including the recent aggressive rate hike campaign, is in complete accordance with this agreement. In the wake of the recent stock market crisis, Powell made a post on social media platform X, stating exactly why he believes this was all planned from the onset. The post reads, "Well, that's going to solve the issue of the global central banks having to refi their debts at high rates. My guess is that rates over time come down to 2.5%. Next up, however, they will need large amounts of liquidity to monetize the previous cycle interest payments to roll it over. That will come in due course. More cowbell." The bigger game is playing out and markets are caught in the middle for now. These macro spasms tend to be rather nasty but relatively short-lived, much like the taper tantrum in 2018, or the fear of a China-EU slowdown and sharp dollar reversal of 2016, similar to now. But they can last a few weeks. Both of these prior episodes saw mass liquidations of assets, as everything goes to a correlation of 1, which soon reversed as the liquidity cycle kicked in. In a follow-up tweet, Powell added, "I've been writing for a while that the Chinese needed dollar-yen lower so they could ease policy without sacrificing the RMB, and Yellen had been over in China twice to discuss this. US rates needed to come lower too to help. That too is now underway. The Japanese revaluation of the yen was part of a larger agreed-upon picture amongst central banks to be able to inject liquidity into the system to revive global growth momentum. A weaker dollar is what everyone needs to add liquidity and loosen financial conditions, and it will mop up this current mess caused by that regime change." Do you agree with Cathie's and Powell's analyses that this is all planned and everything leads to more liquidity, higher prices, and more rapid debasement of fiat currencies? Please share your thoughts in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. We appreciate the support and hope to see you in the next one. Thanks for watching.